This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, it was a very subdued session on Wall Street overnight, that countdown to the US inflation print. But in Asia, we've got some very interesting earnings that are certainly keeping things a little bit more dynamic here.
Yeah, that key focus being the Chinese internet giants, right? Tencent, Alibaba. Where do they take the Chinese equity rally to next, given that there's such a barometer when it comes to the strength of the Chinese consumer? We know that's more of a weakness than a strength, according to the recent data. But Belle, also a big day for Australia, looking ahead to the budget as well, the implications when it comes to investment in critical minerals, but also that balancing act between fiscal stimulus and monetary policy.
Yeah, that's right. And we've got the market open here. And we just mentioned going into the end of the last hour about these producer prices numbers that came out. And just to recap those, pretty much in line with estimates, a little bit firmer perhaps on the year-on-year reading. You can see a rise there of 0.9%. The estimate had been for 0.3, but otherwise in line on the month-on-month basis. As we said, earnings very much the one to be watching here. And you've got SoftBank just starting to trade this morning after we saw it getting a little bit more aggressive in AI. We've seen big asset sales coming through for the company. Also seeing, of course, a surge in some of its portfolio companies or companies within its assets, and that includes ARM Holdings, of course, that listed at the end of last year. So SoftBank putting out better than expected net income in the March quarter, as we said, really helped by those investment gains and derivative contracts as well. So that's the state of play there for SoftBank coming online. Broadly, we are just seeing a little bit of optimism creeping through, as we said, very heavy earnings flow. Korean stocks wise, we're not really seeing too much movement for the broader gauge. The Kospi here, Kosdaq, that's a little bit smaller cap companies pushing a little bit high here. And you've got the Korean won just slightly firmer. But as we said, it is that big countdown to the US inflation print that's due later. So Wall Street pretty quiet overnight.
Well, taking a look at how we're setting up as we look ahead to the delivery of the Australian budget, this is the picture for a pretty sluggish start to trading. In fact, caution all round, as you sort of mentioned, as we wait for that inflation print. The Treasurer, Jim Chalmers, is set to announce back in the black when it comes to the government's books for a second straight year. Australia's fiscal standing now near the top of developed world counterparts. So that's the good news. The more questionable part is to see how they're planning to address the cost of living crisis with this series of rate hikes without undermining the efforts of the RBA and pushing back those rate cut expectations out even further. So that's a picture when it comes to Australian bonds there as well. We are sort of seeing Aussie bonds primed to get a bit of a boost from that budget announcement certainly today, and also watching the impact on the Aussie dollar as well. Quite a few headwinds for Asian currencies more broadly. 66 is where we're trading when it comes to the Aussie, but certainly these twin threats of stickier inflation in the US, as well as the potential for more tariffs on Chinese goods and the potential even for retaliation, as Janet Yellen flagged in our exclusive conversation, is certainly keeping some stronger gains at bay there. And finally, a quick look at oil as we see a pretty steady picture there for crude traders looking ahead to that OPEC report, as well as the CPI data, the clues as to where the supply curves will be extended and the shape of monetary policy to come are really unsurprisingly the biggest drivers there, as we see above $79 a barrel there for WTI. And a picture when it comes to treasuries as well, just edging a little bit higher there. The countdown to April inflation data, I should say. So not huge moves ahead of that print, Bill.
Yeah, certainly that wait-and-see mode perhaps is going to overcome markets. But let's bring in Hartmut Issel. He's head of APAC Equities and Credit at UBS Wealth Management. And Hartmut, I'm curious for what you see here, because we've got, you're still seeing inflation, or rather Fed cuts on the horizon for this year. We're in the midst of earnings season here in Asia as well. What do you think is the bigger catalyst for equity moves over the coming few weeks?
Yeah, morning. I think inflation, or the number that everybody's looking at this week, of course, is only one. As a matter of fact, I would look really at some of the other indicators, and especially in the US, things like consumer excess savings. I mean, been drawing down since many quarters now. There's a little bit left, so I'm not saying seeing massive weakness afterwards, but nonetheless, it speaks for softness. If I look at service PMIs and all these things, they tell us that almost regardless, if the number tomorrow deviates a little bit on the up or down downside doesn't matter so much. The direction of travel, I should say, is in my view relatively clear, and that's for rates to come down. And therefore, in terms of recommendations, we continue to say or to advocate for high quality bonds, and also in the US small caps indeed.
Small caps, can you dive into that, and also your positioning around bonds as well? Just share more details there.
Sure. So on the small cap side, what we like, for example, they're direct beneficiaries of falling rates. So if we compare them with the S&P companies, there's about 10% or so in terms of indebtedness on floating rates, whereas in the small cap space is around 50%. Right? So they're suffering a lot more right now, but once the tables are turning, or the yields are turning, the rates are turning down, then they're an immediate beneficiary, plus they're usually also benefiting from the cyclical part of it.
However, we seem to have taken a bit of a breather when it comes to the Japan equity rally. What do you make of this in terms of what the next phase for this market holds? And does this have anything to do with perhaps some redirected flows now back into China?
Yeah. I believe many investors look too much at the return in Japan in local currencies. That was the case last year, that was the case this year, and then we hear a lot of bullish voices. The moment you translate all of that back into other currencies like US dollars, it is not all that impressive. I'm not saying it's terrible, but certainly it doesn't stand out in any way. And if we look forward now, and if we assume that rates are starting to fall in the US, even if it's only the second half, by the way, we could also well see maybe one more or so rate hike in Japan. So we're seeing diverging policies. Now, when that happens, that speaks for yen strength. And in an index where half of your companies roughly are exporters, then you may actually see the other phenomenon, that the yen actually strengthens, but your sort of performance in local terms is a bit subpar. Also, we don't think the Japanese stock index is cheap enough, really to have significant upside. So we have a neutral position. We're not necessarily negative, but I think that sort of strong optimism that some investors have displayed so far hasn't borne out, and we don't really think it will.
Is China cheap enough? Because we've seen, even with the credit data pretty bleak over the weekend, there's been more investor enthusiasm to lift these markets off the bottom. Does that sort of concern you when we've got a time when certainly the geopolitical threats are perhaps only going to increase with these tariff threats now?
Yeah. Well, as far as China concerned, certainly cheap, although not quite as much as it was maybe end of January. Nonetheless, there is, we think, potential to perform more or less in line with APEC. So we haven't sort of highlighted specifically. What we do like to emphasize, though, is, and you can sometimes see it as a proxy to China, is the Hong Kong market, in fact. Yeah, so typically also as well, the correlation is relatively high. So we currently, technically anyway, prefer but the Hong Kong side to the mainland market.
What about the moves that we're seeing in gold at the moment? Because it has been sort of a bit of a mixed view. We have been seeing that big run up. It's slipped a little bit. But what are you watching there?
Probably ultimately also the Fed fundamentally. But we also need to acknowledge that there's a factor at play here that isn't usually, or that goes a bit beyond the fundamentals, and that's the behavior of central banks. And it does seem in many countries, central banks also looking to diversify maybe their holdings a bit away from dollar and towards gold. So you have, in other words, you have fairly price insensitive buyers in the markets with deep pockets, if you will. That's another factor. So we have a forecast of 2,500 in the longer run, maybe say end of this year, early next year. So there's a little bit of upside, but yeah, not all of it is maybe purely explained by fundamentals.
That was Hartmut Issel there, head of APAC Equities and Credit at UBS Wealth Management. And as we're just discussing with Hartmut, those moves in the Japanese yen, that weakness that we're seeing here is being reflected as well in what we see in the government debt space, because we've got bonds here, those yields that are moving higher. The 10-year yield now rising to its a level we actually haven't seen going back to November of last year. Again, it is that speculation that we're getting that the BOJ is going to be needing to deliver more rate increases sooner rather than later, given, as we said, Haidi, that ongoing weakness in the Japanese currency and that focus on the yield gap between the BOJ and the Fed as well.
And Belle, some of the, just a couple of the key stocks that we're watching in this session. These are the big stories that we've been tracking. A bit of weakness for both of them. BHP Group down by just about 0.3%. This after Anglo-American rejected a second approach from BHP that valued the miner at $43 billion US. Pressure really building now on Anglo to kind of lay out a compelling vision for independence, right? We had BHP improving on its proposal by about 15%, but that has again been rejected in that all-share offer. Crucially, it's maintained that structure, which Anglo has branded as unworkable. So waiting for the next steps and the next moves from both sides, and also whether this is going to kind of spur broader M&A activity across the sector. Also watching SoftBank, of course, set to get more aggressive, even more aggressive. We've seen really Masa make that sharp pivot to AI investment and other fields. They reported a second quarter of profit, a surge in the value of assets, including, of course, holdings, but the strategy in terms of the plans being laid out to be more forceful in AI, and saying that the CFO saying that the balance sheet may not be too conservative. They have, of course, been quietly shedding assets not considered core across the Vision Fund. Well, Treasury Secretary Janet Yellen says China could always retaliate against any steps the US takes to protect its new critical new industries. Yellen declined to confirm, Bloomberg reporting that the Biden administration is about to hike tariffs on Chinese goods, including electric vehicles, but she did tell us exclusively about the president's thinking on trade tensions.
He believes it's unacceptable, as I do, to be completely dependent on China in these areas. And he wants to make sure, given that China is really not playing by the rules, in the sense they have enormous subsidies in critical areas of advanced manufacturing, has resulted in overcapacity. He wants to make sure that the stimulus that's being provided through the Inflation Reduction Act to support these industries, and these are industries that are creating good manufacturing jobs in parts of the country that have been overlooked or have suffered from deindustrialization in the past. The president wants to make sure that he protects these investments. And I don't want to get ahead of the 301 review on tariffs, but this is a commitment that President Biden has made, and I agree with it. I was in China just a couple of weeks ago and made clear that we would not allow Chinese overcapacity to harm our emerging industries.
Does the U.S. want a trade war, though, with China?
We believe that we should have a deep and productive, and that we do in most areas, trade and investment relationship. We're working to stabilize our economic relationship. We do not wish to disengage from China economically, but we do think that the playing field should be fair. And China engages in unfair practices like massive subsidies of industries they've decided are critical. And those are cases where we will act to protect ourselves.
We've seen Beijing in the past, though, respond, and it's become tit for tat. Are you expecting a response? Could they go after Tesla or maybe American farm products? Well,
President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
That was the US Treasury Secretary Janet Yellen speaking exclusively to Bloomberg's Anne-Marie Hordern. And still ahead, Deloitte's out with a new report on generative AI in Asia. Hear why they say students and employees are leading the revolution later this hour. But first, we discuss what's next for BHP after Anglo American again rebuffs the Sweden takeover offer. And BHP, as we said, a little bit under pressure so far in the first 15 minutes of trade. We'll have more ahead. This is Bloomberg.
Muted moves in BHP, one of the stocks that we're watching about 15 minutes into the start of trading, just off by about 0.5% there. This after Anglo American has rejected a second approach from BHP, valuing the miner at $43 billion. The takeover would have made BHP the world's largest copper producer. Let's bring in our metals and mining reporter Paul-Alain in Melbourne. So that all-share bid was increased by 15%. Hasn't won over the Anglo American board. Is it the structure that's the issue here? What do they want to see?
Yes, well, the offer is now up to $43 billion. But yes, Anglo's response was that BHP's approach significantly undervalued the company and its future prospects. So that, of course, including the copper side of the business. Where this risk came from, what it sees as the biggest challenge has been the structure of the deal. So as part of the deal, Anglo would be required to spin off its Amplat's Platinum Group of Metals business and the Kumba Iron Ore business in South Africa. Getting approval and regulatory green lights to spin off those parts of the business are seen as key risks by Anglo. Anglo said that it could take a long time to get those approvals, and at the end of the day said wasn't worth it for its shareholders. Management at Anglo are under a lot of pressure. Anglo has failed to keep up with its peers such as Glencore and BHP, of course, so it is quite undervalued. Around about this time last year, Anglo's board announced that they would undertake a strategic review of their assets and the business as a whole. Shareholders have since then been left in the dark, essentially, not really knowing what's next for the company, but management have overnight promised that today, and scrambled to do this, promising that they would release the strategic review and outline how they'd add value for current shareholders.
Yeah, what in it, that strategic review, as you said, it's been underway for a number of months and perhaps it's been a little bit rushed into the market now in response to BHP, but what is going to be in there that's going to be enough to impress shareholders?
Well, it remains to be seen, but a strategic review like this is usually a precursor to divestments or spinning things off. So one of the things that we'll be watching is Anglo's polyhalite business. That's a fertiliser resource, but it's a $9 billion project with something like a 34-kilometre tunnel that needs to be built to port. This project is requiring a lot of capital, as you imagine, and there's no joint venture partner in there yet. So that's something that we're certainly watching. And of course, De Beers, the diamond business, has been struggling for some time in the current market.
Well, the scramble for copper assets is on, right? Is this going to spark off a wider wave of M&A and competitors to BHP and Anglo will start getting involved? Yeah,
so most people are presuming that there could be another competitive bid, but they're not quite sure where that's going to come from. Broadly speaking, in the copper landscape, copper is really set to soar if you look at a lot of the forecasts out there. It is key for the energy transition. It's key for electrification. It's key for decarbonisation. So, and there's only limited proven copper resources around the world, and those copper resources and those deposits are becoming harder and harder to find. Industry hasn't kept up with drilling holes and exploration, so it's really those deposits that have been found that big business, big miners such as BHP are really looking to acquire, and it's really proving that acquiring assets that are already proven is often better than going out and drilling yourself. There are other companies, Teck for instance, First Quantum, even Freeport to some extent, which could all be on the table in the coming months or years to come.
Metals and mining reporter Paul-Alain Hunt there. More to come here on Daybreak Asia. This is Bloomberg.
Taking a look at some of the big movers this morning, or probably not big movers, but some of the names that are in focus, big companies certainly. Nomura is one of those because we're in that midst of the Japanese earnings season, and they've unveiled a target to almost double pre-tax profit by the end of the decade. So this is Japan's biggest brokerage, of course, and it's looking to generate income before taxes of more than 500 billion yen by 2030. That's around $3.2 billion US. So that's Nomura there. And SoftBank as well. We've seen it sort of fluctuating in the early parts of trade so far, but back into positive territory again. The focus here for SoftBank is the plans that it's announced to get more aggressive in AI, other fields as well, but we saw it report a second quarter of profit and a surge in the value of its assets. Let's get more on SoftBank now, bring in our tech reporter Minjong Lee. And Minjong, what stood out to you the most from the numbers?
The profit, the SoftBank Group's turn to profit was a good thing to see. And you mentioned the valuations and positive things. They have now a net asset value of over 27 trillion yen, which is a record high. And this measure is one of Masayoshi Son's favorite metrics in engaging the health of their own business. And this kind of helps us believe that, like you mentioned, SoftBank is getting more ready to actually start spending money again to invest in AI and particularly chip technologies. Unfortunately, we didn't see much detail on that front yesterday, but these figures, the positive profits, the net asset figure, these are all kind of suggesting that we could expect a more exciting news going forward from SoftBank in terms of investments.
So there's the cash pile that they're sitting on, ready to be deployed, but also we did see the loss for Vision Fund 2. Was that a surprise?
Yes, the Vision Fund still reported a quarterly loss, which was kind of disappointing, and yes, it wasn't quite expected. It speaks to how we still don't have a lot of clarity on their private assets. We have data on publicly traded assets and can kind of estimate how they're doing, but for these private assets, which get written down and we don't have much clarity on, it raises a lot of questions about what is going on there. And the fact that these valuations haven't been quite giving Vision Fund assets a boost is disappointing, but you mentioned the cash pile. It doesn't mean SoftBank doesn't have enough money because it's generating profits on the group level, and because overall valuations have been recovering, and the cash pile is now at like 6.2 trillion yen, which is about $40 billion US. They do have a lot of money to spend, and I think because of these factors, I think we can anticipate more activity on the group side rather than on the Vision Fund side. But we really have to see how things develop from here to be sure.
Technology reporter Min Jun Lee there. Coming up, a closer look at one of the pillars of Australia's budget to be unveiled later today. The country is seeking to move beyond its bread and butter industries. We get more details on the future Made in Australia policy. This is Bloomberg.
Taking a look at some market action this morning as we have Japanese bonds that are trading here today. We've got the 20-year yield rising to its highest level since 2013, so it's more pronounced at the longer end of the curve, but still we already just mentioned earlier the 10-year yield spiking to a point we haven't seen going back to November of last year. It's really this changing market perception that's coming through around where the BOJ goes next. We had really seen Governor Kazuo Ueda playing down the need or the impact of the weak Japanese currency on inflation, but the tone of his remarks seems to have changed after we had that meeting between Ueda and also the Japanese government, Prime Minister Fumio Kishida, and post that point, it has been sounding like there is a bit of more of an urgency to act here, and there's concerns around that one-sided weakness of the yen as well and the negative impacts for the Japanese economy. So you're seeing that agitation for policy change here that could come perhaps at the next BOJ meeting in June, Haidi.
Belle, take a look at how we're trending when it comes to Australian assets as we look ahead to the delivery of the federal budget. A little bit of downside there, broad caution really across the region as we wait, really in wait-and-see mood ahead of the US inflation print. Not a great deal of risk-taking there. We're seeing when it comes to the how particular segments are trading, a little bit of upside when it comes to healthcare and consumer, but by and large we're seeing most of those sectors trading in the red, including the likes of materials and industrials, could be sort of one of the beneficiaries from that budget with that focus on critical minerals. The government is set to unveil the third budget later on Tuesday. Potentially this will be the last before the next election. One of the centrepieces will be the so-called future Made in Australia policies, similar interventionist ambitions to the US Inflation Reduction Act. Bloomberg's Paul-Alain has more.
Australia's economic strength has been built on digging stuff up and shipping it out. It's an old idea which has paid off, and now another old idea is being revived, adding value to those raw materials first. This week in Canberra, billions in new spending will be thrown at green steel, critical minerals processing, solar panel manufacturing and other local industries.
So what a future Made in Australia is all about is not replacing private investment in the opportunities of the future, but attracting more of it. That will require some public investment, and we need to make sure we get value for money for that.
A future Made in Australia is a flagship policy of the Albanese government as it eyes an election campaign likely next year. In many ways, it was born out of competitive necessity. The US has the Inflation Reduction Act, Japan has the Green Transformation Act. Canada and France are giving billions in tax credits to companies developing clean energy. Direct government intervention is having a moment worldwide, and Australia doesn't want to be left behind. An early recipient of a $260 million loan has been Alpha HPA, which produces high-purity alumina, oxides, nitrates and sulfates, critical minerals key to the energy transition. Australia has abundant critical mineral deposits, but limited manufacturing, with the global supply chain dominated by China. Skeptics warn reducing that dominance will require more than nationalist policies and cheap loans.
I think it's critical for Australia to build a so-called alternative supply chains for critical minerals processing. But to replace or challenging China's dominance is impossible, because China's power is not just in the processing technologies, is the entire value chain, supply chains behind it.
With extreme sadness that I confirm Toyota will stop building cars in Australia.
It's worth remembering it was only a decade ago that government subsidies for car manufacturing in Australia were pulled, causing Ford, GM and Toyota to shut down local production. Subsidies and tax breaks are now back for future-facing industries, at least for as long as the political climate encourages it. Paul-Alain, Bloomberg, Sydney.
Let's get some more now with our economics reporter, Swati Pandey, and happy budget day. But when it comes to this Future Made in Australia policy, we don't know a lot, so it could be a surprise. But also, is it too late, given we've just sort of, named all of the other policies that are well entrenched in other economies?
Yes, that is a question mark as well. And because the government has not really announced the detail of this policy, we have not really heard from economists or industry people any criticism or any kind of comment about it. People have broadly said it may or may not be good, it may or may not be inflationary, but it just depends upon what they say, and that is something that has not really been leaked so far. So we will be keeping a close eye on that particular announcement today.
And then we know as well we're expecting some tax cuts to come through, more cost of living aid. Is that something as well that the RBA perhaps really doesn't want to see?
Most of these things have been announced, so the tax cuts have been legislated, the targeted cost of living measures have been flagged, and the RBA has probably taken that into their consideration as well when they raised their inflation forecasts and raised their inflation forecast not just for kind of for the near term. And most economists think that this budget will not be inflationary, but the information we received last night, so $9.3 billion surplus, but then the out years will be a bigger deficit than they had forecast in December, which does mean that the budget is a little bit more stimulatory than it was last year. So there is a little bit of a concern there for the RBA, and we will hear from them only in June now.
So it means that they'll keep the AAA from all three major ratings agencies. There's only 7 countries that hold that, including Switzerland and Singapore. How much of a comfort is that to the government? And if you take a look at, I guess, policy measures and navigating post-pandemic, the post-pandemic environment, is it sort of, the lucky country through luck or through good planning here?
In the past, political climate has been around Australia getting its books in order, and debt and deficit disaster used to be a tagline that the previous government, the Liberal Party, used to use a lot as well. So it is considered a political victory if you do deliver a surplus and you retain your AAA rating. So from that perspective, given that the Labour Party is not doing that well in polls because of the cost of living pressures, if they are delivering a surplus and retaining that AAA rating, it will be seen as a political victory. It is a double-edged sword, though, because people might say that, look, we are having it tough and the government is just bothered about the surplus position. Also, as far as your lucky country comment is concerned, that is an interesting one, right? Because in terms of where that surplus is coming from, it's all commodities prices. And is that luck? Like, maybe that is luck.
It's the eternal question when it comes to Australia's economy, isn't it?
All right, that was our economics reporter Swati Pandey there in Sydney, and tomorrow we're going to be dissecting Australia's budget with Finance Minister Haidi Gallagher and Shadow Treasurer Angus Taylor. You can catch those interviews from 7:30 a.m. Hong Kong time. That's 9:30 a.m. on the east coast of Australia. And coming up, we'll have Deloitte's inaugural Asia-Pacific Gen I report that finds 3/4 of businesses are falling behind on AI adoption. We'll have more on the company's findings ahead. This is Bloomberg. Taking a look at the broader markets here this morning, and it's a little bit mixed as we get underway. You've got Japan here that's sort of standing out, but it's that big earnings focus as well, because we're in the midst of earnings season, and we can get more on that in just a moment. But otherwise, it's fairly steady going so far, so sort of tracks Wall Street overnight, given you've got a lot of investors that are really just counting down to the US inflation print. We should see some signals of moderation, but certainly not the sort of moderation the Fed wants to see if they're going to start cutting rates. So that's the state of play there. The broader gauge pretty pretty steady, as I said, right now. Let's change on, though, because that focus very much coming down to earnings so far, and some of the names that are really standing out. We've got Toppan Holdings at the top here. That does work in printing services, actually provides commercial and publication printing. It is rising here after announcing a share buyback for up to 100 billion yen. You've also got some other names in focus. Dai Nippon Printing, another one sort of in perhaps a similar sector, but again, rising here after its full-year operating income forecast beat estimates. Other names, though, looking a little bit mixed. You've got Aozora and Daiwa Securities here. That story is one that we're watching this morning, given you've got Daiwa that's going to be investing around $330 million in newly issued shares from Japan's Aozora. That's going to give it around 15% or 16% of voting rights. So that will make Daiwa the bank's biggest shareholder. Of course, we have been really tracking Aozora given its exposure to US commercial real estate here, but Daiwa very much under pressure so far. Haidi.
Well, Annabelle, Deloitte has released its first inaugural APAC Generative AI survey. Over 11,000 employees and students across the Asia-Pacific participated, revealing how younger employees are driving the adoption of Gen AI in the workplace. Let's discuss all of that with Robert Hillard, consulting leader at Deloitte Asia-Pacific. Robert, great to have you with us. Some really interesting findings, perhaps unsurprising that you're seeing the younger parts of the workforce and students being the leaders in terms of generative AI adoption. But given how breathtaking the investment has been in this space, has it been surprising that the adoption, the take-up has been less organised in that sense?
It's certainly been inconsistent. Everybody knows that generative AI is important. And we're tagging this generation AI because we've seen the younger you are, the more that you adopt. 80% of students right across Asia Pacific are using AI in their day-to-day lives. But now we're finding 60% of employees are using them day to day. But when we are starting to see it creeping more and more into the workplace, over 40% of employees are reporting that they are using AI at work. And those that are using it on a daily basis are getting more than 6 hours a week of time savings. That's time savings that they're using to improve the quality of their work, to take on tasks and apply skills they wouldn't otherwise be able to, or be able to improve their work-life balance by taking away some of those onerous tasks. But you're right, it's inconsistent. We found that developing countries are advancing much more quickly than developed countries, by about a third. That means that more employees are using it. More students are saying that they're making career decisions in developing countries based upon where they perceive AI will be. And more of the employees are saying that their employer is investing in AI. But there's some gotchas right across that are consistent, which is that those people that are using AI, only about half of them think that their employer actually knows that they're using it at work. And 1 in 5 employers has actually banned AI, but far from being an effective ban, what's happened in those employers where they've banned AI, their employees are more likely than average to be using it, but they're using it secretly. So the message here is employers really need to get on top of this quickly.
Right, that's clear, but also the fact that there's so much suspicion towards it, that a lot of this is happening in a I guess you could say underhand way. Does that go to pointing towards some concerns about the credibility of the work that's done using AI, and does that need to be improved?
I wouldn't use the term underhand. What I would say is happening is this technology is revolutionary, and it is embedding itself into just about everything that we do. People use internet at work. You wouldn't say that's underhand. They do Google searches. They're using AI in everything from their social media right through to their, to their own personal research. So it's no surprise they're using it at work. The reason why it's important that employers are across this is it is not a perfect technology. We know that it can make mistakes. So the quality control is important. But the good news is that where people are using it and well, skilled in it, have got the right skills to use it, they're fact-checking. They're using it in ways that are adding to the quality of their outputs rather than risking too many mistakes. But you're absolutely right. We really have to manage this and manage it well, because all of the trends are that the investments are going to continue to go up over the next 5 years.
And perhaps as well, in response to the issues around possible errors being made or hallucinations, does that also sort of underpin that shift toward more of the private or proprietary domain-specific models?
Yes, we are seeing specialisation. So everybody, became really aware of generative AI when ChatGPT was suddenly launched. But it's not just about those big public models. It's about investment in specialised models, sometimes embedded in the big software platforms, sometimes embedded in the creative platforms, including in social media, and then increasingly in-house. People are building their own models, drawing on open source and other solutions. There's a lot of technology out there to use, and it's actually surprisingly the cost barrier to use it is going down. What's really important is that organisations get a handle on their strategy, a handle on what data do they want to feed into these AI solutions, and then what tasks do they want to try to apply it to, and how are they going to make sure that it's done well. AI can make mistakes, but actually you can put very, very good controls around that and have confidence, because AI can also dramatically improve the quality of your outputs. After all, I'm old enough to remember growing up where I was reliant on the encyclopedia to get my facts. You didn't just trust one page of an encyclopedia, you cross-referenced. That's been no different for all of us as we've used online searches. Now it's no different when we use AI. We can build all of those safeguards in, but we need to plan for it. We need to plan for the automation. That's really the message that people who've been making career decisions around where they perceive AI are giving us when they report back, and we summarise those findings in this report.
This is all sort of like on a company-by-company basis, but what happens when you zoom out and you look more on a country-by-country basis instead, or regional? What are you seeing there?
So we've done a map. We call it the Big Bang Short Fuse. We've looked industry by industry at the impact. We found that over the next 3 years, we're going to see over 1 billion hours of work significantly displaced, changed in the way that those tasks are done right across Asia Pacific every year. And that impact is going to keep on going up. By 2030, almost everybody will be using AI-enabled technology almost every day, often without realising it. Now, of course, it's the activities where it's highly online already, in IT, media, professional services, where we've seen the initial disruptions. But increasingly, we're seeing disruption coming through into the physical world, in things like manufacturing, enabling a wider range of people to be able to apply skills that they wouldn't otherwise have. So it doesn't just become about displacing work. It actually becomes about enabling different people to be able to do work and to be able to do it more efficiently in a wider range of their day-to-day tasks.
That was Robert Hillard, the consulting leader at Deloitte Asia Pacific. Thanks very much for your insights this morning, and we'll have more ahead on Daybreak Asia. This is Bloomberg. Let's get to some market calls that we're following this morning. And JP Morgan's Marko Kolanovic says it's difficult to justify buying stocks now due to elevated interest rates, weakening growth and meagre potential returns. He says the market is prematurely settling back into the soft landing narrative, while the macro outlook is still uncertain. JP Morgan says small and mid-cap stocks are unlikely to beat the return of 20-year treasuries from now until the next recession. Meanwhile, Bank of America says it would take broad global risks for the US to potentially coordinate efforts with Japan to shore up the yen. Strategist Alex Cohen sees the US getting involved only to curb excessive volatility or disorderly and illiquid conditions in markets. He says tacit approval of Japan's unilateral activity seems to be the most the US Treasury is willing to concede at present, Haidi.
BlackRock Bell says it expects a private market boom and if and when the Fed decides to begin reducing interest rates. In the first episode of Bloomberg's new podcast, Tiger Money, the asset manager's Asia-Pacific head, Susan Chan, shares her thoughts on the timing of those much-anticipated cuts.
I'm not sure that the Feds will take the rates down because there's no factor that is, from my personal opinion right now, there are no macro factors today that would have a strong dictation of Feds should move on rates. So I think the rates will normalize around here. But having said that, if rates do go down, the search for income becomes even more prevalent. And that's an area where I think private markets will continue to play a long-lasting support to our client base because of the fact that there are critical themes in private markets. If you just think about, for example, why are people focused on infrastructure and the transition to net zero? That will take place over a long period of time. And these themes will generate significant amount of returns. And irrespective of where rates are, I think this trend is here. So that's a trend irrespective of rates, even though it might be bumpy depending on, sort of how quickly rates move. But I have a firm opinion personally that the rates are normalized and will be quite stable for at least the remaining part of this year.
You've always provided me with very good advice, whether that's on career, investment. What's the best career advice someone has given you?
Don't worry about the things that are out of your control and focus on things that you can actually control on a day-to-day basis.
Love that. And then as a senior female executive in the finance industry, what's your take on breaking through the gender and cultural bias, and how does that help women in finance succeed?
This is a multi-decade journey, and I think every step is a win. So let's do everything one step at a time, and let's not try to think we're going to make some massive changes overnight, because we need everyone to join us on this bus and, take this journey.
That was the BlackRock head of Asia Pacific, Susan Chan, speaking to Bloomberg's Tiger Money podcast. And you can stay tuned for more from Tiger Money. It's co-hosted by Bloomberg's David Ingles and Rebecca Sin as well, for conversations on investment strategy with industry and business leaders. That's going to be every second Tuesday from today, and you can find it on Apple, Spotify, YouTube and Bloomberg.com. But a lot of the action so far, and actually Susan Chan spoke to us about Japanese equities being an investment opportunity, but a lot of the action so far this morning and what we're seeing in the bond space, because it is that rise that we're seeing in yields here really led by the longer end of the curve, given you've got traders agitating for some sort of policy change from the BOJ in response, of course, to the weaker yen. We're actually just hearing from Japanese government officials here saying that they are watching these yields. They will respond, Haidi, as necessary.
Take a look, Belle, when it comes to how we're setting up US futures looking like this as we head into really these building expectations of what that inflation print will come out as. Also seeing a little bit of softness there when it comes to Taiwan futures as we get into the open. The China Show is next.